Hello and welcome to Investors Hangouts. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, with interest rates likely to go down, it's a good time to buy debt funds. But wait, why did I say that? What is this relationship between interest rates and debt funds? And how can you capitalize on it? That's what we'll discuss about in today's episode with Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
Let's begin with this relationship between debt funds and interest rates. How does it work?
It's a very funny relationship, and most investors are quite intrigued by this. That when interest rates go up, bond prices go down. Simply because when interest rates go up, all the older bonds will keep yielding the lower interest rate on which they were issued. So they fall in value. And this is something which most mutual fund investors who are naive investors, who don't understand that interest rate went up and I was hit by the loss. So when interest rates go up, mutual funds fall in value, debt funds or bond prices go down. When interest rate go down, bond prices appreciate exactly for the reverse reason, that you are holding bonds which will be yielding higher return as of yesterday and before. And future interest rates or future bonds will be issued at lower rates. So they become pricey. So far, randomly interest rates were going up. But now we have come to a point where interest rates have stabilized. It looks unlikely that they will go up any further. And looks likely that either it will stabilize, it will remain where it is, or there is a small likelihood that at some point, not necessarily near future, but some foreseeable future or reasonable future, it will go down. When interest rates go down, then some kind of bonds, they appreciate in value much more than other kind of bonds. Long maturity bonds, because the commitment or the promise to yield higher, give higher interest for a longer period, they go up more because the promise is to give you more return, more higher coupon for 15 years, 20 years. So depending, so longer the maturity, higher the appreciation. So long gilt funds, which are, gilt, which is issued, investing in bonds issued by the government, they are free from any credit risk. They are unlikely to default. They are also likely to honor each and every promise of giving you interest on time. And they also happen to be the only only bonds which are of longer maturity. Corporate bonds are not available in longer maturity or as longer maturity as the government bond of 10 year, 15 year, 20 year, 25 years and so on. So they do appreciate in value the moment interest rate go up, and that could be an opportunistic investment for investors. But normally at Value Research, we have a slightly different and little passive and little boring view about how to go about investing in bonds.
Okay, now with that in mind, who should invest in debt funds and why?
Oh, the investment in debt fund should be for very basic reason, irrespective of what the interest rate is, whether it will go up, whether it will go down. And debt, I'm talking of the whole gamut, whether it be fixed deposit, whether it be a debt fund, whether it be buying a bond, whether it be buying an infrastructure bond for some opportunistic reason, or whether it be your public provident fund investment, because that is also fixed income. I consider it as a mainstream debt investment. You should have debt for two reasons. One is that you want a part of your money to be completely insulated from market risk. And you want that part of your money to be reasonably stable. So the money which is in public provident fund, or the money which is in debt fund, or the money which is in fixed deposit, it might go down a little bit, but even if they go down, they don't go down by 1%, 2%, but there is never a significant loss of capital. You can't put all your money in equity. So the money with which you can't take chances, that should be in debt. The other is that, to have a nice sleep at night, you need to have a relatively more stable, your overall portfolio, stability of your portfolio. And for that, we keep telling time and again in Investor Hangout that have a fixed income allocation, have an asset allocation. And that fixed income allocation should be there irrespective of the state of the market. It should be dependent on your comfort level. That, you get very upset if markets go up and down dramatically, or you are comfortable with it, then you can have a smaller fixed income allocation. But every investor should have a fixed income allocation. And that is why you should have debt.
Okay, so fixed income allocation and higher stability you get there.
Higher stability, yeah.
Why debt funds? Debt funds vis-a-vis FDs?
Why debt fund? Because you have the flexibility. You don't have to lock into a term. Then the biggest advantage, debt funds were very much more attractive earlier, but despite that attractiveness gone, there is a very significant advantage which investors are unable to appreciate. Two advantages. One is that you are able to diversify. When you invest in a debt fund, you are actually lending money to 20 people or 20 entities, 20 companies or governments and things like that. So you are de-risk on that front. One significant advantage is that you are not liable to pay taxes on the appreciation till you realize it. Because you have 25% today.
Right.
And then you are doing your SIP in equity fund, and next year you take some money out from equity and move it into debt. And it once again becomes 75-25. Till you realize that any part of the gain from your debt investment, you are not liable to pay taxes. All other bonds, except PPF, is taxable. The interest that you get from a bank deposit is taxable. Even if it is a cumulative deposit, you are supposed to pay taxes on the interest that is accrued to you, because that is the accrual accounting principle followed in filing returns. So, and in case of a bond, same. And the moment tax is payable from the interest that you earn, your capital gets lowered.
All right, so higher stability, better liquidity, potentially higher returns than FDs, and then taxable only when you redeem.
When you redeem it.
Okay.
And also lowering the risk because of diversification.
Right. But there are some 15 categories of debt funds. So how does one choose the one best suited for their needs?
Well, I would like to simplify for most investors. Don't try to get venturesome with debt. It doesn't make sense to get adventurous with debt simply because most investors should actually invest in equity for their long-term growth. And when you are choosing an asset for stability or for near-term requirement, why take chance? Also, the moment you take chance to optimize or maximize your return in the short run, your capital will be at stake. So for little higher return, you can't risk that you will not get the return of your capital. It's very important to ensure that you are investing in a conservative manner. So I would say that most investors should do without getting adventurous with their debt investments. Okay. They should invest in short-term debt fund, and that is a principled view we have taken at Value Research. In all our advisory portfolios and things like that, we think that investing for less than 6 months, invest in a liquid fund. It's virtually close to being no risk. Second is, little more than that and couple of years for all your requirements, short-term debt fund will do the job. And if interest rates go down, they will get you little more return. And for the extra adventurous one who don't want to take chances and they want to invest for 1 or 2 years and they will be willing to get a kick out of if interest rates go up, then maybe consider today investing in a long-term gilt fund is not that risky. Simply because the likelihood of interest rates going up is very low, but still you can get surprises. And if you can hold it for a longer period, you will be able to optimize, or you can once in a while get quite a substantially higher return.
All right, so that's about debt funds. Now, before we wrap up this episode, we have a viewer's question that we'd like to answer. Rohan asks, what is the best valuation metric or group of metrics that a simple retail investor should see before investing?
There are just too many of them. And it depends on whether you are trying to understand the valuation of the overall market or a specific security. Specific security, it is very simple. Go to Value Research Online and we give you a valuation grade of each and every stock. So you will figure out that if this valuation grade is above this, then it is very pricey. If it is below this, then it is cheap. But then you have to see the valuation of each and every security, each and every company's stock in relation to its quality, in relation to its growth, and in relation to its corporate governance and many qualitative things. So you can have a great company which is available at a very fancy price. And historically it has been. So it could be an internally relative thing. A company could be expensive or cheap depending on what it has been historically. So I would say that individual securities, go to Value Research Online, look at this valuation matrix. Besides that, we give you 3-4 things which is unique to Value Research Online, which is price to book value historical of that company, price to earning ratio going back many years, going back 10 years, and in relation to its 3-year median, 5-year median, 1-year median. So you can see how this company stacks up as of now. If you're thinking about, changing your allocation, that okay, market is very expensive, or everybody is thinking that market is very expensive, how do you measure it? I would say that there is no simple way of doing that. But I would like to give you one qualitative pointer or indicator, and it has worked in very nicely. In last 30 years, whenever the market has become very exuberant, the market has gone out of whack and it has been expensive, something like January 2008 or something like 2001 when the tech boom, before the, while the tech boom was on, or sometime in 1992 when the Pied Piper effect of Harshad Mehta, or, those big, zoom leap of the market. Those things can be very easily anticipated, though it is very it is nearly impossible to call it when you are in the middle of it. But I would say that simply, when you have this mainstream newspaper, Jagran, Times of India, Indian Express and Hindustan Times, when the headline of these newspapers become stock market, then it is time to worry. And when, people say that when your, pan shop wala, or when your milkman actually starts talking about market, then it is time to worry. So that is one of the bigger points in terms of when you should worry a little bit. But what can you do about it? It is very hard to get out of the market when the market is in the middle of that, roaring boom. So I think, the simplest thing that you should think of doing and effectively implementing is working on an asset allocation plan and making sure that you are periodically rebalancing it. And when a market like this happens, when, it's zooming, going up and, and you will start regretting if you do a very binary choice, that is the time when you should do it more often. If you are getting worried, do it every quarter. So you will be able to take a part of the gain, but you will not be out of the market. So asset allocation, rebalancing, don't try to time it. There is not a single measurement. Specific security, you can have measurement.
All right, well, that's all we have for you in today's episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Thank you for watching. Take care. Bye for now.